Hello there, and welcome to the fourth episode of this kind, the fourth episode of Financial Deceptions, a series where I look at different public information that, in my opinion, give the opportunity to the management to present information that sound great, have good sentiment, but in reality, it is not so great. Now, in this episode, I want to focus on free cash flow as a metric, and the video will be divided into segments. First, I want to walk you through an example of a company that I just made up. It's called the Best Lemonade Stand. And then we're going to take a look at a company that is very public, that has a significant market cap. I'm sure that you've heard of it, and to see how this example compares with what the management does there. Now, before I move into this example, what free cash flow stands for based on the definition is it's cash from operations, so really the cash that has been generated minus the capital expenditure, so the investments that the company does in intangible assets or PP. So that is the definition, that is the starting point. Now let's take a look at this particular example. I've decided to open a company, and it's going to be a very innovative one. It's going to be a lemonade stand. And there is not really much upfront investment, so I've already had all that in my garage. I already had all the equipment, so I didn't make any investments. And I decided to hire someone to work within the company, and I'm just going to be laying back and just chilling. So what this company does is it makes 10,000 in revenue in year one, and this is a part-time job for an employee. Let's say this is a friend of mine, and it increases by 10% year over year. So the gross profit is about 70% gross margin. It's quite nice. And I agree with my friend that I'm going to pay him in shares. And he says, look, that sounds fine to me. This business is worth quite a bit, and I've done my math. I don't mind. But it has to be 200 shares amount because you're owning 10,000 shares. So you own 100% of the business at the moment. So I'd like to have 200 shares amount. And we agree on this amount. So 200 shares every single month. That is the payment. But accounting wise, it's an expense. So I have to have it here. And the business is doing better every single year. Now, of course, my ownership changes over time, right? My ownership changes over time. I start with 100%. At the end of year one, I have 81%, and I have 68, and I have 58, and well, that was my decision, right? But if we take a look at the free cash flow, right, based on this definition, what we need to do is we need to add back the salary because I'm not paying that in cash, right? So the business is generating 6,500 in free cash flow. That's 7,000 and 7.8. But my portion of that is decreasing every single year. Now, of course, this is not something that any company discloses how it has changed for the existing owners, but this is one that they all boast about. This is what happened to the free cash flow, despite the fact that they have been diluting the shareholders. And I'm looking at this number and I'm thinking, well, wait a second, maybe this decision wasn't really good. Maybe I should have just paid in cash. Maybe it was more worth to just retain my 100% ownership. So I give my friend a call and I say, look, let's make a deal and I'm going to buy back your shares. How much money would you like? Well, let's keep it at the same amount that we initially agreed. That was the salary. So we agree on that. I buy back all the shares. And what you'll notice is the free cash flow, if I adjust for these buybacks, is much lower, right? But this decision to buy back shares is a decision that has nothing to do with operations or capital expenditure. This is a decision, it's a financing decision. So within the cash flow, you will see that as part of the financing activities. So if I have decided to pay the salary in the first place, right, then this would have been my free cash flow based on the definition. If I pay it in shares and later on buy back the shares, which is exactly the same at the end, the free cash flow looks much higher, right? Because this is based on the definition, right? Nothing when it comes to share buybacks is included here. And look, I'm not saying that any company is avoiding the rules. This is just the definition. They're playing by the rules, but the rules are a bit, in my opinion, not in favor of those who do not understand all the definitions and can get misled by this. Now, let me introduce to you Dropbox. This is a company that by 2024 expects to have 1 billion in free cash flow, right? So this is an incredibly important number. And if we take a look at some of the metrics, right? Free cash flow was 500 million, 700 million, So it is growing over time. All right, so this company, based on these numbers, is doing well. Now let's take a look at their financials. And I want to start with the income statement. Revenue is growing. If we take a look at the operating income, about 300 million. So wait a second, they have 300 million in operating income. That's before taxes and all the other stuff. And they are bringing free cash flow of 700 million. So this is already a bit off. Okay, well, we know that there are quite some adjustments. We already saw that you can add back the share-based compensation, this. So they're adding a lot of that back, right? So they're starting with the net income, well, adding all of this stuff back. The cash from operations is 700 million. They don't have much expenses. Well, when that is the case, then of course the free cash flow looks amazing, right? They have more than 700 million in free cash flow. But what about the shareholders' dilution? Let's take a look at the shares outstanding. If you take a look, maybe I can move this here. What you'll notice is that the number of shares outstanding have been decreasing. Wait a second. You might say, Costa, you just pointed out that that cannot be the case. Oh wait, are they buying back shares? Take a look at that. Cash from financing, repurchase of common stock, over 1 billion, 900 million, 800 million. And if you take a look at the cash flow, the free cash flow, right? It is actually lower than what they have been using to buy back shares in order to reduce, first of all, to compensate for the new shares that have been issued, and then later on for additional buybacks to reduce the number of shares. So if you take a look at this number here that has been mentioned, I don't think this is useful. I mean, it excludes a significant expense that, based on a very, very difficult example to create a very complex structure of a lemonade stand, we could see that it is not free, right? It is free based on the definition, but what it represents is not the actual value that the company has added. It represents the free cash flow from real cash point of view that the management has on their hands, that they can use for various reasons. They can decide to acquire a new company. They can decide to pay back maybe some of the debt. Maybe they can buy back shares. But on its own, this is not the cash, the pure value that the company has generated over time, over this period of time. So this is incredibly important. At least I look at that, because if a company makes a different decision to maybe paying cash, compensate a higher percentage of the compensation of the employees in cash, that would have impact on the free cash flow. So the management has the ability to influence this by structuring the compensation in a way that more is being paid via shares. And I don't think that's really adding additional value, as you've seen in this example. Only because the free cash flow goes up doesn't mean that the value that the existing investors get is increasing as well. And I'd like to end this video by showing this meme, and I think this is a great one. This is the management bringing in the Trojan horse, free cash flow to the investors, but inside are, of course, the stock-based compensation. I think this is a great meme, and it has been used time and time to basically to present positive numbers, because of course you have 1 billion of free cash flow. And what are we going to do with that, right? Obviously, it's not fully correct. But on the other side, in defense of Dropbox, that is the definition. So they'll get to 1 billion. Well, maybe they'll compensate more in shares, but hey, this is the definition. But this is really the reason why I decided to make these videos, because I believe that there's a lot of information that sounds much better than it is, and this is a great example of that. I hope that you enjoyed these videos, and if you have any questions, comments, or suggestions, please do let me know. And as always, I'll see you in the next one.